Do you know what caused the crypto market crash back in May? If you're a retail crypto investor, your answer is probably China's crackdown on crypto mining. If you're an institutional crypto investor, however, your answer is probably ESG concerns. Now, believe it or not, this little buzzword has the power to make or break the crypto market because most of cryptocurrency's total market cap is institutional money. That's why today I'm going to tell you everything you need to know about ESG and how institutional investors are using it to invest in crypto. Before I explain ESG, there are some terms and conditions to which you must agree. If you're looking for financial advice, you won't get it from me. That's because I only make educational content about cryptocurrency. If this is your first time at the Coin Bureau, my name is Guy, and I reckon I just told you my MO. That's to make educational content about crypto. Coins, tokens, news, reviews, and a bunch of other topics you didn't know. If you're down to learn something new, subscribing to the channel and pinging that notification bell is what you should do. Time is of the essence, which is why I've left timestamps below that you can use to skip between sections. However, I strongly recommend that you watch this video until the end. So now that we've dotted the I's and crossed the T's, let me tell you about the metric that every institution is using to invest in cryptocurrency. ESG has its origins in a letter sent to the CEOs of the world's largest financial institutions by the former Secretary General of the United Nations in 2004. These financial institutions, along with the United Nations, World Bank, and the Swiss government, produced a report called, quote, "Who Cares Wins," in 2005, which first coined the term ESG. In 2006, this coalition formed a, quote, global network of investors called the Principles for Responsible Investment, or PRI, which is neither a corporation nor a non-profit. How odd. Now, naturally, signatories to the PRI are committed to ESG investing. The PRI currently has over 4,000 signatories, 75% of whom are asset managers, aka the big money. ESG is essentially a series of criteria which its creators believe financial institutions ought to examine before making an investment into any company, country, individual, etc. These criteria fall into three buckets: environmental, social, and governance, hence ESG. These terms are obviously very broad, but they're pretty self-explanatory at the surface level. Environmental criteria include stuff like how much carbon dioxide does the company emit, how much green energy does it use, how efficiently does it manage its natural resources, etc. Social criteria include stuff like how employees are treated, how much holiday leave they get, how much they're paid, gender equality, minority representation, all that stuff. Governance criteria include stuff like how companies are structured, how transparent that structure is, how much influence shareholders have over companies, cybersecurity, and so on. If you're wondering who sets ESG criteria, the answer is a lot of people. There are more than half a dozen ESG ratings companies, and though there are differences between them, they all share the same naughty list. Companies considered off-limits by ESG investors are those involved in the following: alcohol, tobacco, gambling, adult entertainment, weapons, fossil fuels, and nuclear power. One of these things is not like the others. Now, anyways, the largest ESG ratings company is currently Morgan Stanley Capital International, or MSCI. MSCI gives corporations an ESG ranging from CCC to AAA score using 37 criteria, and recently began giving some individuals ESG scores as well. More on that later. For a long time, ESG wasn't anything more than a meme amongst institutional investors. Besides the discrepancies in ESG scores given to corporations by all the different ESG ratings companies, compromising on fossil fuel use or hiring employees based on anything else other than merit meant ESG-oriented corporations were often crushed by their competition. However, this changed in January 2020 when Blackrock CEO Larry Fink wrote a letter to the CEOs of all the companies Blackrock is invested in. In case you missed the memo, Blackrock is the largest asset manager in the world, and it's invested in just about every major corporation in every economic sector. Larry's letter, titled, quote, "A Fundamental Reshaping of Finance," called for all of the corporations BlackRock is invested in to operate in accordance with ESG criteria. 1 week after Larry's letter, the world's elite gathered in Davos, Switzerland for the World Economic Forum's annual conference. There, they collectively decided to standardize ESG criteria along 22 metrics with the help of the Big Four accounting firms and the International Business Council, or IBC, which is headed by Bank of America CEO Brian Moynihan. I'm pointing this out because the Bank of America recently released that lengthy crypto report, and ESG was the first topic it tackled, although most of the details were buried in one of the report's many appendices. Now, I actually did a video about that report, and you can find it using the link up there in the top right. As you might have guessed, ESG criteria have expanded ever since that January 2020 meeting in Davos. ESG criteria now include components from the World Economic Forum's Fourth Industrial Revolution, along with the concept of stakeholder capitalism dreamed up by the World Economic Forum founder Klaus Schwab. If you're wondering who the stakeholders are in stakeholder capitalism, Klaus said it himself in a recent interview. The World Economic Forum was created so that stakeholders could meet at Davos. I don't remember seeing you there. Guess you didn't get the invite. And that's not all. Over time, 12 more metrics will be added to the ESG criteria so that it is also in line with the United Nations 2030 Agenda for Sustainable Development. Now, I know what you're thinking. Guy, this is starting to sound like a bit of a conspiracy theory, and man, I wish it was. In a recent episode of What Bitcoin Did, Peter McCormack spent an intense hour talking about ESG with Kevin O'Leary. For those who don't know, Kevin is a multimillionaire who works closely with institutional investors around the world. Kevin revealed that almost every single asset manager in the world has an ESG committee of some kind, and these ESG committees take a hardline stance on ESG criteria. In other words, institutional ESG committees don't care if the company in question is about to cure cancer. If they're using excessive fossil fuels in their operations, they won't get a penny from institutions. When Peter asked Kevin where all this ESG pressure is coming from, the answer is the letters about ESG that BlackRock CEO Larry Fink has been sending to all the CEOs of the companies BlackRock is invested in. According to Kevin, these letters have changed the attitudes of all the companies which make up the S&P 500 and reshaped the global economy. This is because any CEOs who ignore the ESG directives in Larry's ESG letters do so, quote, at their own peril. If you want to see how powerful BlackRock is, Kevin says to look no further than the energy sector, which is getting, quote, crushed by BlackRock's ESG push. Kevin even admits that he and his affiliates caved to BlackRock's pressure to stop investing into energy companies despite their impressive earnings and their attempts to become cleaner energy producers. As for the crypto crash earlier this year, Kevin pins that on ESG too. He believes that Tesla dropped Bitcoin payments not because it would affect its allocation of carbon credits from environmental regulators, but because institutional ESG investors threatened to pull the plug on Tesla. This was also pointed out by other prominent personalities such as ARK Invest CEO Cathie Wood. She said that Tesla's reversal on Bitcoin payments inspired institutional investors to take a closer look at Bitcoin through an ESG lens, and them dumping their BTC bags over environmental concerns is what ultimately caused the crash. Now, this barely scratches the surface of all the insane stuff Kevin had to say during that interview, and I'll leave a link to it in the description. Not to be dramatic, but it might be the most important interview you'll ever watch, so be sure to check it out after this. Being aware of how much of an influence ESG has had on Bitcoin and the rest of the crypto market, you might be wondering what ESG-inclined institutions think of crypto now that the prices are closing in on their all-time highs. As highlighted by analysts at MSCI in a recent podcast episode, the ESG factors associated with cryptocurrency, quote, have yet to be understood. And that's quite a statement coming from the top ESG ratings company. Even though this is the case, cryptocurrency investment is becoming more and more common among institutions, so much so that the MSCI recently warned of, quote, creeping cryptocurrency exposure in equity markets. From what I was able to gather from my research, the environmental ESG aspects of cryptocurrencies are slowly starting to take a back seat to social and governance factors. This is primarily because proof-of-work cryptocurrency mining is becoming greener as crypto mining companies shift to using renewable energy. As I mentioned in my video about crypto mining and the climate, crypto mining companies are incentivized to use the cheapest forms of energy available because it increases their profit margins. It just so happens that the cheapest energy around is renewable, and this has created a massive incentive for miners to migrate to greener pastures such as El Salvador's volcanoes. China's crackdown on crypto mining has also helped Bitcoin and other proof-of-work cryptocurrencies with their ESG scores, since oversight of renewable energy use is much easier to do in countries like the United States, where many crypto mining operations have moved to. The only real pain point left on the environmental side of ESG has to do with electronic waste. The ASICs used to mine Bitcoin and other proof-of-work cryptos are built for just one purpose, and many of them end up in landfill after the newest model comes out. Luckily, there are protocols in place to ensure e-waste is properly managed, and the e-waste from crypto mining is negligible compared to comparable industries. As pointed out by Bank of America's massive crypto report, the news we keep seeing about crypto's effect on the climate is probably nothing more than coordinated FUD to trick ESG-sensitive investors into selling their sats. In the social department of ESG for cryptocurrency, it looks like what we're seeing there is a lot of FUD too. Over the last weeks, there's been a lot of news about the use of cryptocurrency in illicit activity, be it ransomware or money laundering. While this might be a great talking point for anti-crypto politicians, the institutions aren't buying it. The FUD, that is, they're sure as heck buying the crypto. That's because the institutions have the numbers. Fewer than 1% of all cryptocurrency transactions are related to illicit activity. As far as social metrics go, institutions seem to be much more concerned about the volatility risks associated with crypto. While it's true that virtually every single cryptocurrency investor is aware that cryptocurrency is volatile, it's also true that the average crypto investor isn't all that educated about what they're investing in, which is another social issue institutions are on the lookout for. The only other social factors ESG investors seem to be focused on relates to transaction disputes. As we've all found out through our many mistakes, all cryptocurrency transactions are final. And this is something that institutions are not used to. If the Bank of America report is anything to go by, though, institutions believe the social benefits of cryptocurrency far outweigh the risks, especially in the long term. This is simply because cryptocurrencies facilitate financial inclusion, and their efficiency often means lower transaction fees and shorter settlement times compared with legacy finance. After all, there's nothing that the institutions want more than your money, and the more people they can get on board, the more wealth they can grab when they manipulate the market. And no, this isn't a conspiracy theory either. Watch my video about the Wyckoff method if you want to learn more about institutional market manipulation, and that is in the top right. This leaves the final ESG category, and that's governance. Now, oddly enough, governance metrics seem to be top priority for the institutional ESG kind. The MSCI spent almost a third of its recent blog post about cryptocurrency discussing governance, and it takes issue with the informality of governance structures around proof-of-work cryptocurrencies such as Bitcoin. Now, obviously, Bitcoin has no CEO or board of directors. The Bitcoin blockchain is technically governed by miners, developers, and BTC holders. Miners can choose to go along with developers or not. Developers can choose to go along with miners or not, and BTC holders can choose to go with the miners or the developers or take their money elsewhere. This messy governance structure is a big part of what makes Bitcoin so secure, because there's no single third party you can pressure to implement whatever feature or bug you're pushing for. Even so, MSCI is apparently making a list of all the most influential Bitcoin developers and miners. I wonder why. Anyways, whereas we think of governance as being something that's bottom-up and community-driven, institutional investors see governance as being something that's top-down and government-driven, aka regulations. The relative absence of regulation around cryptocurrency is the main governance issue institutional investors are watching. And though this is improving, what the institutions are asking for is quite excessive. For example, they are in favor of the FATF's plans to connect every single one of your crypto wallets to your real-world identity using KYC and automatically track every transaction above a certain amount. The absence of governance among some cryptocurrencies also makes certain regulations hard to enforce, which is why institutions are fond of proof-of-stake cryptocurrencies. In addition to being more environmentally friendly, proof-of-stake cryptos allow for the kind of stakeholder capitalism that I mentioned earlier, one wherein the institutions can buy up the voting power they need to implement the regulations they want to see for any given cryptocurrency. This is explicitly stated in the Bank of America report that I mentioned earlier. If you're not a fan of this ESG stuff, you'll be happy to know you're not the only one. There are many ESG critics, and most of them are actually found in the ESG industry itself. For starters, you have Tarek Fancy, BlackRock's former CIO of sustainable investing, who recently said that ESG has zero social impact and is just a, quote, giant societal placebo. Then you have SEC Commissioner Hester Peirce, who slammed ESG funds back in 2019, saying that they engage in, quote, public shaming and shunning wrapped in moral rhetoric preached with cold-hearted, self-righteous oblivion to the consequences which ultimately fall on real people. Ouch. Pro-crypto billionaire Chamath Palihapitiya called ESG a, quote, complete fraud and explained that megabanks like JP Morgan can borrow billions of dollars from the European Central Bank at negative interest rates just by saying they're pro-ESG. Even the average institutional investor seems to be pretty perplexed by ESG, given that all it does is pump up the stock of a company while often undermining the fundamentals that give the company in question any value. The most frequently raised concern by financial analysts across the board is the fact that almost every single ESG fund continues to invest heavily into companies you would think would score very low on ESG. An easy example here is tech giants like Facebook, who have shown zero scruples when making a mockery of social and governance metrics. ESG-obsessed institutions often insist that the environmental efforts of these kinds of companies make up for the damage they're doing in the other departments, but their bias is hard to ignore. Put simply, it looks like institutions use ESG as an excuse to exclude any companies they don't like or don't comply with their demands, and keep the ones that follow along, ESG be damned. Funnily enough, the pushback against ESG from within cryptocurrency has been minimal at best, and that's probably because almost nobody even knows it's a thing. I certainly didn't appreciate its importance until that Bank of America report came along. This is a big problem because ESG investing creates a unique set of issues for the cryptocurrency industry. Starting with the environment, the ESG focus around killing fossil fuels seems to have had the unintended consequence of sending the price of energy through the roof around the world. Whether it's the cause or not, it's making things worse, and this means the profit margins for proof-of-work cryptocurrency miners are getting smaller, and if this trend continues, Bitcoin could be in a bad spot. This is because it would be easy for ESG ideologues to argue that the limited amount of energy around is too valuable to be squandered on such a wasteful technology as Bitcoin. I covered the risk of the energy crisis to Bitcoin mining in a recent video of mine, so feel free to watch that later by hitting that link in the top right. Anyways, on top of that, ESG's intense energy oversight could quickly lead to the centralization of mining power. It was recently reported that Bitcoin mining operations in the United States account for more than 35% of Bitcoin's hash rate, more than a 4x increase since last year. That's certainly good news, but it runs the risk of tipping to the other extreme, where the overwhelming majority of Bitcoin's hash rate is coming from the United States, as it once was from China. As I mentioned earlier, ESG investors take issue with the absence of governance for proof-of-work cryptocurrencies, primarily Bitcoin. In theory, all you need to govern Bitcoin is the majority of the mining power and Bitcoin's most influential developers. Blackrock & Co. are investing heavily in crypto mining companies, and recall that ESG ratings companies like MSCI are compiling lists of Bitcoin developers. This is all they would need to take control of the Bitcoin blockchain, as they can easily supplant any retail money that pulls out of BTC. Again, this would be very easy to do for proof-of-stake cryptocurrencies because the token holder is also the miner in that equation. When it comes to social ESG metrics, it looks like institutions would be quite happy to cut retail investors out of the equation, as per the recent MSCI podcast. I don't exactly blame them either. Most of the volatility in cryptocurrency is coming from inexperienced traders who are using too much leverage, and this has arguably done damage to anyone who holds crypto. Transaction reversibility also seems to be on the menu, though it's unlikely this will ever be enabled at the protocol level. Instead, institutions will likely opt for third-party cryptocurrency custody, where transactions can be reversed because they were never really made in the first place, so to speak. This ties into the biggest risk of all, which is, of course, governance, aka regulation. Institutions seem to be dead set on forcing KYC everywhere they can. Combine that with the individual MSCI scores that are starting to pop up at some financial institutions, and you have a slippery slope to a totalitarian financial system wherein purchasing certain products will lower your MSCI score and prevent you from getting a loan, or potentially even making purchases at all. If you think the government will save you, I'm sorry to say that a similar structure is being put together by central banks with their CBDCs, and you can learn all about that by clicking the link in the top right. That's it for my analysis of ESG and cryptocurrency. I hope you learned something new, and if you did, smash that like button. If you think this information is important, be sure to share it so the word gets out. Remember to subscribe to the channel if you haven't already, and ping that notification bell to make sure you don't miss my next crazy crypto video. Until then, you can check out Coin Bureau clips for behind-the-scenes action and original flicks, and follow me on Twitter, TikTok, and Instagram for hot takes, outtakes, and AMAs. If you feel like you're falling behind in the crypto market, join my Telegram channel to get all the daily crypto updates you need to stay up to date. Better yet, subscribe to my weekly newsletter to get the tools, tips, and tricks you need to ride the bull market to the moon and beyond. Last but not least, consider supporting the channel by getting yourself a beanie, hoodie, sweater, or tee from the Coin Bureau merch store. I have some new items in there that I think you're going to love. Links to these resources and many more are waiting for you down below. Now, thank you so much if you stuck around. Whatever you do, don't forget what you learned today. This knowledge will come in handy when the crypto world starts to get wonky. Watch the institutions closely, and I'll keep you up to date as much as I can. This is Guy, signing off.